So what are the effects of quantitative easing on economies and stock markets? I've taken a deep dive into all the academic papers out there, and the conclusions are quite all over the place. While certain papers conclude that quantitative easing has little to no effect on economies and stock markets, others state the exact opposite and conclude that quantitative easing does impact economies and stock markets. Now, a few of the most common arguments in favor include that the benefits of quantitative easing outweigh its costs. Quantitative easing can provide crucial relief to economies in turmoil, and that quantitative easing is a viable monetary tool as it can be reversed, diminishing the potential danger of hyperinflation. Now, the most common arguments against include that there is no clear evidence of quantitative easing benefits an economy nor stock markets. The excess reserves banks get do not immediately translate into loans, since banks tend to hold on to the majority as a safety precaution for a possible increase in defaults. And the third and last one is that quantitative easing can be too effective, causing hyperinflation. Now, the academic papers out there that research the effects of quantitative easing on stock markets lean more towards the conclusion that quantitative easing has a positive effect on stock markets. And a few of the most common arguments includes that as quantitative easing normally coincides with the zero lower bound, which is interest rates being near 0%, long-term interest rates of treasury bonds would decline and consequently offer lower returns. Now, this incites investors to look elsewhere for better returns. And while equities present a higher risk, stocks will become more attractive investments. Now, demand rises and prices naturally follow the trend, therefore increasing stock market prices. Second one is that the announcement of quantitative easing can alert investors to the prospects of the economy. If this prospect turns out worse than expected, stock prices may drop in the short term. However, successful quantitative easing should lead to increased stock prices over the long term. And the third and last one is that there should be an emphasis on the importance of taking into account trends and cyclical events when analyzing its effects. Now, it seems that the overall effects of quantitative easing are quite uncertain, as the papers out there are largely contradictory. In the next video, we'll take a deep dive into the lessons that we can take from history. And we'll look into how high-profile use of quantitative easing in the past affected stock markets. So I'd love to hear, which side are you on? Do you believe quantitative easing affects economies and stock markets or not? Let me know in the comments down below.